not only do we have an ongoing government shutdown, global turmoil, and a $37 trillion financial reset, but after months of nonstop profits, we have just witnessed the worst single-day stock market point drop since April's sell-off.
The United States market today is caught in a vortex of uncertainty and mounting stress, buffeted by unpredictable policies, aggressive tariff maneuvers, and the looming specter of a sudden crash. What once appeared to be broad-based growth and relative stability now reveals fault lines running deep through trade, finance, corporate balance sheets, and investor sentiment. The fragile equilibrium has been disturbed, and what we are witnessing may be a slow unwind toward greater turbulence. At the heart of the crisis lies the trade policy gambit pursued by the Trump administration, which has unleashed sweeping tariff changes and threatened further escalation. These moves have injected considerable unpredictability into economic planning. Firms and importers confront not just higher costs, but wholesale ambiguity about what the next policy turn might be. Businesses report delays in investment, abandoned expansion plans, and a reluctance to commit to new contracts, all because tariff rules may shift at a moment's notice. This policy whiplash spreads risk across supply chains and narrows breathing room for firms already squeezed by inflation and rising rates. The tariff strategy has also taken a heavy toll on U.S. competitiveness in export markets. As manufacturers face retaliatory tariffs and stiffer barriers abroad, export demand from America has softened. A large percentage of businesses say their overseas sales have declined since the tariff escalation. Meanwhile, the broader economic burden is being shifted to consumers. The effective cost of import taxes has translated into hundreds of dollars in additional household expenses this year alone. The cumulative drag on growth is becoming harder to ignore. Sustained protectionism drags the economy through multiple channels: reduced business investment, squeezed profit margins, and retaliatory trade measures. Financial institutions and analysts warn that the odds of a disorderly global market correction are rising, with the potential to ripple through every major financial hub. As costs rise and revenues become unpredictable, corporate earnings face mounting pressure. Margins that once absorbed minor shocks are now vulnerable, particularly among firms heavily reliant on imported inputs or global value chains. Some sectors are resorting to cost-cutting measures, while others delay hiring or capital expenditure. If earnings continue to disappoint, stock valuations, already stretched in many areas, could face severe downward revisions. Investor psychology has responded violently. The markets have already flirted with collapse. Earlier this year, following a major tariff announcement, U.S. indices plunged within days. The Dow lost more than 1,600 points, and the S&P 500 fell nearly 10%, in one of the sharpest two-day market slides in years. A core problem is that bond yields spiked alongside, exacerbating borrowing costs and triggering broader financial stress. Market confidence is fragile, and the fear of contagion looms. If one corner of the system fails, the interconnections among banks, private credit, and shadow finance could spread the damage. Even some of the biggest financial leaders have warned that small failures now may be signs of deeper systemic weakness, reminiscent of the pre-2008 period. The uncertainty now extends beyond just trade. Macro signals are ambiguous. Inflation remains stubborn. The Federal Reserve walks a tightrope between containment and growth, and government deficits are ballooning. With little policy clarity, investors are squeezed between higher interest rates and overvalued equities. Many analysts argue that current asset prices are not well supported by fundamentals. Because of that, even small negative triggers, such as a weak earnings season, a geopolitical flare-up, or renewed tariff escalation, could send the market into another spiral. Trade tensions with China, in particular, remain a powder keg. China has accused the U.S. of manufacturing panic over rare earth controls, and retaliatory measures could deepen supply chain disruptions. The threat of 100% tariffs on Chinese goods has already rattled global markets and sparked sharp sell-offs in technology stocks that rely heavily on international components. Close observers see parallels to prior trade conflicts, but this time, the scale and stakes are higher, and investor patience is running thinner than ever. The damage is not limited to equities. Credit markets, especially those involving riskier corporate bonds and private credit, are vulnerable. If defaults rise in overextended sectors, the stress could easily propagate to banks exposed to those instruments. Financial institutions have repeatedly cautioned that the interconnectedness between traditional banks and non-bank financial firms could be the channel through which systemic risk spreads. In a worst-case scenario, the U.S. could face strains reminiscent of past financial crises, with capital fleeing risk assets and liquidity drying up overnight. Domestically, the labor market is showing signs of fatigue. Reports indicate a decline in middle-class manufacturing jobs following the tariff announcements, as well as slower job growth and rising unemployment claims. Firms are becoming cautious with hiring or shifting to short-term contracts. If demand softens further, consumer sentiment, already fragile, may crack completely. A loss of confidence can quickly turn into reduced spending, feeding a downward cycle of weaker growth and falling employment. In this environment, any deviation from optimistic expectations can trigger disproportionate reactions. A disappointing earnings report, a sudden drop in consumer spending, or another tariff escalation could ignite cascading sell-offs. Some market watchers debate whether recent corrections are opportunities to buy the dip or warnings of a deeper downer. The concern is that volatility now tilts decisively toward the downside. The risks are large, and the safety nets are few. Several structural weaknesses amplify the danger. Valuations in many sectors remain high relative to earnings. Many investors are leveraged, chasing short-term momentum rather than fundamentals. And liquidity can vanish rapidly when too many players try to exit simultaneously. The Federal Reserve's ability to cushion a downturn without reigniting inflation or worsening fiscal stress is limited. At the same time, political pressure on the Fed is rising, threatening its independence and increasing the risk of policy mistakes. All of this leaves the U.S. market in a precarious position. The positive forces of innovation, productivity, and corporate resilience are being outweighed, at least for now, by policy uncertainty, debt risk, and eroding investor confidence. The path forward will not be smooth. Sharp drops, rapid reversals, and fear-driven sell-offs could define the months ahead. For investors and companies alike, this environment demands strategic caution. Diversification, hedging, and contingency planning are no longer optional. They're essential. Companies will need to build more resilient supply chains, reduce exposure to unpredictable tariffs, and prepare for tighter credit conditions. For investors, preserving capital may be more important than chasing short-term gains. And for policymakers, restoring clarity and predictability may be the only way to stabilize markets and rebuild trust. In short, the U.S. market is standing on a knife's edge. Unpredictable trade policy, mounting tariffs, fragile earnings, and stretched valuations have combined into a volatile mix that could trigger further shocks. The balance between confidence and collapse has rarely been thinner. Whether the system bends or breaks will depend on whether leaders choose stability over confrontation, and whether markets can still believe that order will return before it's too late.